Welcome to our next lecture, How to Analyze and Interpret the Financial Statements. In this lecture, you will learn how to distinguish between horizontal and vertical analysis, how to compare financial statements between the companies and within the industries, how to explain the calculations of basic ratios, and you will learn the limitations of financial statements analysis. Let's start with the introduction to financial statements analysis. We will look here more on the analysis issues than on how to prepare the financial statements. Let's start with the reasons. Why do we need financial statements analysis? Basically, we are answering several questions in this analysis. And the first one, the main one, is how do we know if the investment in the company will provide a required rate of return? This is the main question which investors ask themselves. And they will basically make their decisions based on the results of such analysis. The next question is how do we assess whether a loan or trade payable will be repaid? We should be able to understand our perspectives. The next question is how to be sure that the company is consistently approaching its goals. And in this sense, we will say that financial statements analysis really helps in achieving goals by the company. And finally, how do we find the causes behind performance and how that performance links to the company's strategy? Let's distinguish the financial statements analysis. And we will start with financial analysis terminology. It basically represents the process of examining a company's performance in the context of the industry and economic environment. This is done in order to arrive at a decision or recommendation. This actually depends on the goals. Now, financial analysis can be represented within three main sides. First, it helps us to evaluate whether we are able to earn a return on our investment. Second, this return should be equal to the cost of capital, at least equal, or even exceed it. And third is that the company should be able to generate enough cash in order to meet its obligations. Now, in financial analysis, we usually start with the information which is contained in financial reports. Basic financial statement analysis usually provides us some foundations which enable the analysts or users of these results to better understand other information which was gathered from research beyond the financial reports. But basic financial reports, as you already know, include audited financial statements, disclosures, and such disclosures are usually required by regulatory authorities and by IFRS Foundation as well, and accompanying commentaries which are usually issued by the management and included in the final report. Now, what do we already know about financial statements? Let's have a look. We know that companies prepare financial reports at a regular basis, which means that they will issue their reports annually, semi-annually, or quarterly, depending on the requirements. Second, financial statements are the results of accounting process. And as you know, accounting process represents the records of the company's economic activities. And these records are done with applicable accounting standards and principles. And third, we know that financial statements are usually audited by independent auditors. Especially, this is true for the listed companies, or we will say those for which IFRS standards are in force. Now, let's recall what complete set of financial statements usually includes. As you know, the complete set will include a statement of financial position as OFP or a balance sheet, a statement of comprehensive income or income statement, a statement of changes in equity, and a statement of cash flows. And all of those are quite important in our analysis. Why? Well, first, balance sheet, as you know, portrays the company's financial position at a given point of time. And basically, we can say that balance sheet is a snapshot of financial position of the company at a point of time. The statement of comprehensive income and statement of cash flows will present different aspects of company's performance over a period of time. The statement of changes in equity provides additional information regarding the changes in company's financial position. And in addition, the accompanying required notes or footnotes, which we spoke beforehand and which are issued by management, usually are considered as an integral part of a complete set of financial statements and should also be taken into consideration while making financial analysis. Now let's look at the balance sheet and income statement, and let's compare the basics of these financial statements. First of all, as we said, balance sheet is a snapshot of the company's assets and liabilities at a given point of time. That's just the same. On the left side, you have assets. On the right side, you have liabilities. Or you can have vertical balance sheet where you have assets in the top of your report and liabilities in the bottom. Now, assets will be listed in order of decreasing liquidity, which means that less liquid assets will begin our report, will open our report, and will be placed in the top of the balance sheet. Now, cash, as the most liquid asset, will be positioned in the bottom of our balance sheet. We should also recall the balance sheet identity, which is represented as basic accounting equation, which is assets equal liabilities plus equity. Now, as for the income statement represents us the operations for a specified period of time. Remember the difference? Balance sheet is a snapshot at a stated point of time, and income statement represents operations for the period of time. So that is the basic difference. But also, what income statement tells us about is the revenues first, and then the deductions of the expenses for the stated period. Income statement will also follow matching principle, which assumes that revenue will be accepted and matched with the expenses which are required to generate the revenue. Now, cash flow, another important financial statement. The cash flow is one of the most important pieces of information that a financial manager can derive from financial statements. And cash flow statement represents us a statement that summarizes sources and uses of cash. In this statement, we will see where the cash comes into the company and where it goes. The changes in financial statement of cash flows will usually be divided into three major categories: operating activity, investment activity, and financing activity. Remember these three different activities represented in cash flow from the previous lecture? Operating activity usually include the net income and changes in most current accounts. Investment activity includes changes in fixed assets, and financing activity includes changes in notes payable, in long-term debt, in equity accounts, as well as in dividends. In the statement of cash flows, we can represent the equation of the cash flow from assets into versions. The first equation shows us how the cash flows from the firm and how it is divided among the investors who financed the assets. As you see here, CFFA equals to the cash flow to creditors plus the cash flow to stockholders. The second equation in the cash flow represents us how the company receives from its assets. And this is a very important equation to remember. We will come back to it later on, and we will use it again when we do our capital budgeting analysis. Here, basically, we want to base our decisions on the timing and risk of the cash flows which we expect to receive from a project. And you can see that here CFFA will be equal to operating cash flow less net capital spending less changes in net working capital. Now, standardized financial statements. It is an important part to remember that in financial analysis, we will not only use just normal statements, normal financial statements in their basic form. Often, we use standardized financial statements. What do we mean when we say standardized? We represent balance sheets and income statements by computing all accounts as a percent of total assets or as a percent of sales in case of income statement. Now, the standardized statements will make it easier to compare financial information, particularly as the company grows. These types of statements are also useful to compare companies of different sizes, particularly within the same industry.